And welcome everyone to another Smart Money Circle episode. I'm Adam Sarhan. With me today is Sylvia Kwan, who's the CEO and CIO of Ellevest with approximately $1 billion in assets under management. Sylvia, thank you so much for taking the time and welcome to the Smart Money Circle.
Thank you so much for having me on the show, Adam.
So I always like to begin. Can you please tell us your story and how you got to where you are today?
How much time do you have? I'm just kidding. Um, so my entire career has been spent in financial services, but I did not start out with that intention. My undergraduate degree is actually in applied math computer science, and I was really intending to have a career in software. And I decided late in my senior year, while I was interviewing at technology companies, that I wasn't going to be happy doing that. So I had to really quickly pivot and figure out, what I wanted to do. I knew what I didn't want to do, but I didn't know what I wanted to do. And so I landed actually at an investment firm in an 18-month management training program where you rotated every 3 months into the different departments of the bank, which was perfect for someone who kind of didn't know what I was going to do. So I spent, 3 months in HR and 3 months in IT and all these places. And my last rotation was in the quantitative investment division of the bank. And that's really where I found, wow, this is really interesting, the whole dynamic nature of financial services. And it also kind of played into kind of the analytical side of my training, kind of in applied math and computer science. And so that's really how I started my career, a little bit kind of randomly in some sense. So I was there at that firm. I started out managing a fixed income portfolios for pension funds. So that's how I started my career. I then decided, since I didn't really have any formal training in kind of economics, to go back to graduate school. After graduate school, I joined Schwab Investment Management. So I switched over to the retail side. I was hired to oversee their quantitative equity strategies. I wasn't there for very long before I joined my first startup. It was my first mission-oriented firm, and really the first financial technology firm, first fintech firm, I would say before fintech actually became a thing. It was called Financial Engines. And what Financial Engines was trying to do was really to bring institutional quality advice to the average American. That I was there for more than 10 years. It was really a phenomenal experience. Just being part of a team that built something from the ground up. I found I loved the startup culture, wearing different hats, the uncertainty, the innovation. And since then, I've really never looked back. Um, so fortunately, Financial Engines went IPO in 2010. That really allowed me to really have a long runway, in some sense, pseudo retire. But I also, I love the financial industry, and I knew, I just didn't want to step away completely. So I started a boutique RIA, got to about a dozen clients. It became very much a lifestyle job. And it was a way to really keep engaged with the industry, but not really work very hard, to be fully honest. So that was really going to be my retirement end game until Sally Krawcheck reached out in late 2014. And she told me what she was trying to do was really create a company that was going to help women invest. And she wanted to do it in a digital way. So while I thought I was done with startups, it really was a great opportunity that I felt I could not pass up. Having a mission to help women to invest, doing so in a digital way, and really being able to bring all of the experience that I had from financial engines to bear into a new company, and bringing all of the things that we learned, the mistakes that we made, and creating kind of something again from scratch. So I came out of my comfy lifestyle job and jump back into the frying pan. So I did join Ellevest in 2015, so about 10 years ago, as Chief Investment Officer. And as you know or may know, our co-founder and prior CEO, Sally Krawcheck, stepped away from her day-to-day CEO job, given some health issues, and she asked me to step up. And so I now have the dual role of Chief CEO and also Chief Investment Officer.
Wow, I love that. What a great
That's,
story.
that's how I got to where I am.
Well, okay, beautiful. So this is a good segue into the next question, which is please tell us about Ellevest, your business, what you do, and your investment strategy.
Sure. We are an SEC registered investment firm that is helping women, families, and the next generation, as well as institutions, invest with intention. As I mentioned, Ellevest was founded 10 years ago with the mission of closing what we call the gender investing gap. So, what is the gender investing gap? It is really based on the notion that women have been largely sitting on the sidelines when it comes to investing. What we heard, we spent probably the first year at Ellevest, really trying to understand like why women were not engaging with investing as much as men were. There's a study from BlackRock that shows even year after year, the average US woman's portfolio is 70% in cash. And so if there is a gender pay gap, if women are not being paid at the same rate that men are, and if they are not investing at the same rate that men are, and that money has to last longer because in general, women live longer than men, women are not set up for financial success. So Ellevest was founded really to help close those gaps and help women invest in a very easy way and to help really lower the barriers that women perceive in the financial industry and help them invest. So we started out with a digital investing service, and then a few years later expanded into private wealth. Earlier this year, we sold the digital investing service, and so today our core service offering is wealth management and financial planning. So today we serve high net worth investors and institutions who really want to invest for both returns as well as align their portfolio with their values.
Gotcha. Well, that sounds great. As far as the investment side, are you more fundamental based, technical based? How do you play the game, so to speak?
Yeah, so our investment philosophy, I like to think about it as really focus on the things that you can control with investing. And so obviously, we can't predict, well, I would say nobody can predict kind of where markets are going, right? And so what we do is we try to reduce risk through diversification, reduce costs by keeping an eye on fees, and then also reduce tax liability by being smart about taxes. Those are things that we feel we can control. What we don't try to do is predict what the Fed is going to do, predict what markets are going to do, and then try to position our clients' portfolios to take advantage of that. So not much in terms of active management, just because the history shows that has not been largely successful, really focused on well-diversified, globally diversified portfolios at low cost. And where we do want to add alpha is actually in the private markets. So that's one of the, I would say, real advantages of really starting from the ground up. When we started private wealth, we didn't have a single client. That's the disadvantage, obviously. But the advantage is you can really start from a blank piece of paper and take what we did was we took what we believe was working really well in wealth management, and then had the ability to change things that we thought were not serving the client well. I also had to really think hard as chief investment officer, what is going to be different about Ellevest, other than, yes, we had this focus on women, but from an investments perspective, how are we going to differentiate ourselves, from Goldman Sachs or JP Morgan, and why would a client move from a well-established, reputable firm to a largely unknown firm like Ellevest? So two things that we decided that were going to be our differentiators. One was really investing with returns and impact. So really for our firm, helping clients really create an entire portfolio. So that includes global stocks, global bonds, and alternatives to align with their values and have the kind of impact that they want to have. And then the second thing is really leaning much into private markets. As as public markets continue to shrink. I think we hit a peak in something like 1996, and there's like less than half publicly available equities than there were at the peak. And so we felt, especially for clients who met the qualification to be investing in private markets, if you are not including that, your universe of investable opportunities continues to shrink. So we really felt that investing in private markets had a lot of advantages, especially in terms of diversification. We believe that not all alternatives are created equal. I'm happy to talk about kind of the things that we do there, but those were the things that we decided were going to make us different. It took obviously a few years to kind of build that out. But today, that really is our biggest differentiator, and the reason why clients come to us from much larger firms, because they're actually looking for some of the unique investment opportunities that we offer that are not offered at other firms, to both enhance their portfolio from an investments perspective and at the same time make a positive impact.
I love that. So thank you for that explanation, and I love the differentiators. Let's talk about risk management. How do you handle risk, and what are some mistakes you see people make with respect to risk management?
I think that the most effective means of managing risk is really through diversification. That's really how we manage risk. So on global equity side, publicly traded equities and bonds, we're not trying to take on any additional risk. And so what we're trying to achieve there is to achieve market rate returns at low cost. We are just trying to, whatever the market is, that's what we aim to get you at low cost. It's similar with bonds because it just doesn't pay to take on additional risk to try to pursue outsized returns. Where we feel we can really help lower overall portfolio risk is through these alternatives. And the kinds of alternatives that we seek are really those with no or very low correlation to publicly traded stocks and bonds. And so what you want, a lot of times when people think alternatives, like the traditional alternatives come to mind, like, hedge funds or, global macro or long short, things like this, and, of course, real assets and things like that. We don't generally have a lot of those traditional ones like hedge funds, because many of those tend to amplify equity risk. And what we're trying to do is use alternatives to offset equity and bond risk to really lower overall portfolio and at the same time generate income when we can and enhance returns. And so we use alternatives to really help manage risk. And, I will say one of the silver linings for 2022, we would talk to clients about, why, we have such an allocation to alternatives. It's due to the diversification, really want true diversification. They would nod their heads or their eyes would glaze over and they were like, yeah. And then 2022 hit and they saw, their stocks were down, their bonds were down, but the alternatives were really stabilizing and many of them were up. And so I think having that experience really helped our clients understand what it means to have true diversification and help them understand why we do what we do. So, I think that's the main way that we manage risk, is making sure that we have those kinds of alternatives that really help offset the other parts of the portfolio. With respect to, other, mistakes, other people, the second part of your question here, it is interesting because
I didn't get to the mistakes yet. I just wanted to stay on the risk management side. So the risk management side, if I understand you correctly, you're saying diversify, make sure you understand that you can't time the market from a traditional sense of anticipating or predicting what's going to happen because of XYZ. Incorporate alternatives into the portfolio. Did I miss anything else from a risk management side before we move on? Just to make sure I summarize. Okay, perfect. Thank you. Okay, before we get to mistakes, I do want to ask you about timeless lessons. So you've been around for many, many years. You've just a phenomenal career. I love it. You moved from applied mathematics to finance, and I'd love to learn, before we go to the mistakes, what are some timeless lessons you've learned along the way that you'd like to share with the audience? And it could be from specifically the gender focus, closing the gender gap with women, with men. Do women invest differently? Do they handle risk differently? Do they have different anywhere you want to go, please, Sylvia, we're very much looking forward to how you answer that.
Gosh, I can go in all of those directions. I'll try to keep my answer short though. So I think the biggest lesson that I have learned over along the way has really been that successful investing for the long term takes patience and courage. I think there's too much of this impatience, trying to make things go faster or get returns more quickly, and also kind of more and more with how quickly information gets out there. And then also social media, watching other people, make millions, when they started with $1, things like that. There's just a lot of, this fear of missing out. And so I really try to encourage our clients is there will always be opportunities to generate returns. Like that is just what I love about the financial industry is there's always innovation. There are always opportunities. And so there's never a situation like, oh my gosh, I didn't get in early enough, or I missed the boat on this, or, there's always this kind of fear of, oh, I missed out on the AI boom or, whatever, I don't think that's obviously true. And so I think really instilling this, it actually takes patience. And it also, that the courage part comes in, not overreacting to news and really having a long-term plan and sticking to that plan. That's the big lesson I learned. Chasing performance is another painful lesson that I learned in my 20s. In my 20s, you think you know everything. And I watched this Russian mutual fund, this mutual fund of basically Russian stocks. I know nothing about Russian stocks. Actually, I know nothing. And it was just climbing like crazy. And I'm like, oh my gosh, I need to get in. I need to get on this gravy train, right? So I bought, I used probably the bulk of my meager savings to invest in this Russian, and it did go up a little bit more. And then I wrote it all the way down. And that was just a huge lesson about chasing performance, and kind of this, oh my gosh, I have to, I need to get on this. Otherwise I'm going to lose this opportunity. There won't ever be one, ever again, kind of feeling. And if you got to really, um, really accept that, there will be other opportunities, and really to have that patience and that discipline, to keep moving forward.
Love it. I love it. Okay, now let's get to the mistakes, please. What are some timeless mistakes you've learned that you'd like to share with the audience?
I think the mistake that I see a lot again is is related to chasing performance, but it is, I think, very much related to when things are going really well and everything's humming along, everyone downplays the risk. You kind of forget. You're like, oh, what could possibly go wrong? The economy's humming. This is great. Market keeps going up, and you just forget about risk. And then when things are very challenging, investors allow the fear of risk to cloud their decisions. And so often we hear, from clients, when the U.S. markets were going up, the question was, why can't I have all U.S.? Why do I have to have exposure to, emerging markets or developed markets or what have you, right? And then, today is the opposite question. Like, oh, U.S. is, oh, look at developed markets, look at emerging markets. Can we just have all of that? And then in 2022, when they saw their alternatives go, can I just have an entire portfolio of alternatives? It's just sort of like this, it's a little bit of chasing performance, but it's just feeling like, why should I own things that are going down when, I could be owning things that are going up? And the truth is, as you know very well, we can't predict, what is going to be next. So, I think, that is one of the mistakes, is just having a different perspective of risk depending upon the macro environment and what's recently happening. And I think it's really important to continue to manage risk and to be cognizant of risk, even especially, when things are going well, and remembering that, hey, things can turn around at any minute, and you need to be well positioned for that.
I love that. So I use an example of a red light, green light. Every stop sign anywhere you have a green light, everything's great, but it's going to go yellow, then it's going to get red. And then after red light, everyone's all panicking. It's the worst thing in the world. After every red light, there's a green light. Right. So I totally
Exactly. We're only
love
human.
it.
Easier
Exactly.
said than done.
So love that. All right, Sylvia, let's talk about leadership. What makes a great leader, and what are some lessons you've learned about leadership that you'd like to share with the audience?
Oh, so much. I think resilience in the face of challenge is probably one of the things that has been the greatest lesson and also beneficial, certainly for me as I step into this new role. Being able to adapt quickly to fast-moving environment, and also keeping an open mind that there might be a better path, than the one that you're going down. I think many times leaders, at least I see leaders like, oh, I made the decision. We're going down this path. We're going to, that's the path we're going down. And there's new information that comes up, or there's new feedback from clients. And if you don't kind of have that open mind and um, have some openness that, maybe there's a better direction, or, you may be wrong about this because of the new information. I think that is really important in terms of being a great leader. And I would say the second thing is uh, really being decisive when it comes to decision making and being clear on how decisions are being made at the firm. Have seen this a lot at a lot of the companies that I have is, it's great. Everyone provides input, and, I love leaders that do solicit input from the team and kind of bring the team along in the process. I think that's very important. But at the end of the day, somebody has to make a decision. And if it's not you, you need to decide and let people know, it's like, thank you for your input. This team is going to make the decision and we're all going to go. And I've seen so many situations, especially in startup, like we're analyzing, discussing, and, week after week, there's no decision made. And sometimes I know that from the team, it's like, we just need to make a decision and move. Like, at this point, I don't even care what it is. We just need to make a decision. And I think that indecisiveness or lack of clarity on who the ultimate decision maker is can really wreak a lot of kind of havoc and impact the morale of the team.
It's a really good point. So let's talk about adversity. How do you handle adversity, and what are some obstacles that you had to overcome along the way?
Adversity, I think handling it with patience for others and myself. I think for myself is probably kind of the more challenging of the two. I think for adversity is really focusing on the things that I can control, or you can control, I can control, I guess, and really not spending a lot of time worrying about or being anxious about the things that you can't. So somewhat similar to the investment philosophy that we have at Ellevest is really, you know, even when you think about, for example, the current environment, all of our clients are worried, about what's happening in the US and the country and tariffs and inflation. And, there's plenty of things to worry about, right? What can any of us do about, those things is pretty minimal. And so helping, my clients and even myself in deciding what are those things that you can focus on. Well, you've got, investments, you can be more intentional. And this is kind of brings us back to, why we help our clients be more intentional. If you're worried about, climate change, for example, there are so many investment opportunities for you to invest for both, returns as well as helping to, close some of those gaps. If you're worried about homelessness, for example, is there a way for you to invest in affordable housing? And so, I found that taking some kind of action, in the direction and doing things that um, help you create some of the change that you want to see, as opposed to fretting about the things that you can't, I think is really kind of key in my perspective. What I try to exercise is much easier said than done, for sure, though.
I absolutely love that. You're saying that there's an elephant in the room, or whatever that piece of adversity is, instead of ignoring it, hoping it goes away, address it. Even if it's a small step in that direction, it's better than not taking any action. Is that a correct way
That's
of
right.
some?
And just worrying, talking, fretting into, you have a lot of conversations. People are like, oh, this is terrible. I don't know what I'm going to do. I want to move out of the country, or I want to do this. And, and really kind of like unpacking. Okay, one thing is sort of unpacking, what is the real thing that you're worried about? And then figuring out like, hey, is there something that you can do in this place that you are anxious about that is within your control, and that actually can be really powerful.
Well, thank you for that. Final question for you today, Sylvia. What is the best piece of advice you'd like to give the audience or your 30-year-old self?
I would say, kind of from a career perspective, I'm just going to do from career perspective is to reach for more than you think you are capable of. And I say that because of lessons that I learned along the way in my career. Earlier on, I was offered a chief investment officer position, and I ultimately turned it down because I felt like, oh, I've never been in this position before, and I don't have all of the boxes. I have some of the boxes, but I don't. And I'm not sure that I can really do this. And I ended up turning it down, and I think that was a mistake. And I realize now that, nobody checks all the boxes, right? And if somebody offers you a position, they have confidence in you, and you should have confidence in yourself. So I like to kind of share that with others, hey, reach for more than you think you're capable of.
I love that. Yeah, it's funny because actually I had Sharon on, who's Sharon from Build-A-Bear, the CEO of Build-A-Bear, and she had the same kind of trajectory where she was offered a job and it was a really high level job, and she had the same thing where she was like, yeah, I don't know if I can do it. She didn't believe herself. Finally, she regrets not taking that earlier job, but it helped. It was a learning experience, and then she became who she is today and was able to take over and grow the company and all that kind of fun stuff. So I've had similar situations. I'm very familiar with what you're sharing here, and I couldn't agree more. That inner conversation, that inner critic, if you will, is just a force to be reckoned with. You got to deal with him or her.
Exactly, exactly. And sometimes I feel like you have to have made the mistake to have learned from it.
Right, absolutely. Well, Sylvia, thank you so much for taking the time to speak with me today. Congrats on all your success. This was really fantastic. Hopefully, we'll have you on again soon.
Awesome. Thank you so much, Adam. Really appreciate being on the show.